Good afternoon, all of you. On behalf of the Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the webinar series on Guide for Efficient Cost Audit. Our today's speaker, CMA Dushyant Dave sir. I welcome sir. Also, I would like to introduce sir. He is a founder of DC Dave and Company, Cost Accountants, Cost Audit Bank Empanelment as ASM, Chairman Decode Group, Turnaround Management and Business Advisory. He is a Bachelor of Commerce, LLB, FCMA, and Executive Education, Wharton School, USA. He has 30 plus years experience in cost audit and cost and management accounting, manage, managing cost audit for leading industry houses of India across the sectors. He is consulting in cost reduction, costing system, SAP benchmarking, etc. He is a former member of the Cost Accounting Standard Committee, Institute of Cost Accountants of India. He is a turnaround consulting and management services, advises bank, ARCs, and private equity funds. Also rendered financial services, investment banking, mergers and acquisition, PE across sector, and handled large transaction. He is highly networked with banks, institutions, corporates, and the states and central government. He is a recipient for the 2023 Turnaround and Transaction Award from the India at TMA USA. He is impaneled cost audit firms. His cost audit firm impaneled as the monitoring agency with the Indian Banks Association. Also, he is a speaker at various professional forums and visited the USA, Singapore, Hong Kong, UK, and Swiss for the profession. He is a mentored many CMA interns and practitioners and other professionals. Also, he is a associations membership and accolades with IMC Chambers of Commerce and Industry Mumbai as a managing committee member for over 10 years, chaired the Banking, Finance, Private Equity and Capital Markets Committees. He is a member of CIA and member of Turnaround Management Association USA. I welcome sir and request sir to kindly start the session, sir, please.
Thank you, Prajanka, for a pretty long introduction. I'm a fellow CMA practicing cost accountant for all of you who are attending this webinar. Very good afternoon to everyone. It gives me a great pleasure now to do the webinar series 2. We started with the audit to advisory, and now we are getting into the core functions of the audit and the cost accounting record rules. And I will call it an efficient cost audit, as you will see. This is going to be a pretty good long webinar. Please keep your charger on your laptop or a phone. And it's going to be very, very useful. It's going to be a little interactive as well. And I assure you that you'll have a lot to take away with you. So just don't use it only for your CEP credit hours, use it for a great knowledge collection exercise. I am powering my entire experience of last 25 years plus into this particular technical webinar, as we call it. So it gives me a great pleasure to welcome all the members of the Institute, as well as some of the clients who are working in the costing department head, whom we have invited as well to the first session of this webinar series on the guide to efficient cost audit. Cost audit has undergone a remarkable transformation over the last decade. Today, it is no longer viewed merely as a statutory requirement under Section 148 of the Companies Act. Regulators increasingly expect cost audit reports to provide meaningful, reliable, and analytically robust information that supports the policy formulation, industry benchmarking, and informed decision making. In my interaction with the practicing cost accountants across the country, one recurring concern has been the practical difficulties faced while preparing the annexures forming part of the cost audit report. Although the statutory formats are prescribed, professionals often seek guidance on the audit approach, the supporting documents to be examined, the verification procedures to be performed, and the practical issues encountered during the field work. This particular webinar series has therefore been designed to bridge that gap. Rather than merely discussing the statutory requirements, we'll focus on a practical implementation, audit methodology, professional judgment, and common pitfalls observed during cost audit assignments. My endeavor throughout this series will be to share practical insights drawn from professional experience so that each participant is better equipped to conduct an efficient, effective, and value-added cost audit. Now, about this webinar series. Uh, Before we begin today's technical discussion, let me briefly explain the structure of this webinar series. I put it on the slide on the screen. Instead of attempting to cover the entire cost audit report in a single session, we have divided it into 4 focused modules. Cost audit report is so large that we just cannot give justice in one particular webinar session itself. This will enable us to discuss each annexure in sufficient depth and from a practical perspective. The objective is not merely to explain what information is to be reported, but to understand why that information is required, how it should be verified, what documents should be examined, and how the auditor should evaluate its completeness and reliability. By the end of this series, I'm sure the participants should be able to approach every cost audit assignment in a structured and systemic manner. Now, why efficient cost audit matters? Why I've called it an efficient cost audit? Why not just a statutory cost audit? One question I often ask during my training programs is this: who is the cost audit report actually meant for? Many participants instinctively respond that it is meant for the cost audit branch of the central government. While that is correct, it is only part of the answer. A well-conducted cost audit creates value for multiple stakeholders. Management gains valuable insights into cost structures and operational efficiencies or inefficiencies. Regulators rely on the information for policy analysis and industry benchmarking. Lenders and investors derive comfort from the robustness of the internal costing systems. Therefore, cost audit should never be approached as a routine compliance exercise. Every annexure in CRA 3 contributes towards presenting a comprehensive picture of the company's cost structure and operational performance. The changing role of the cost auditor, as I said, the expectations of the cost auditors have evolved significantly. Earlier, our primary responsibility was limited to verifying the arithmetic accuracy of cost statements and ensuring compliance with statutory requirements. Today, stakeholders expect much more. We are expected to understand manufacturing process, evaluate internal controls, assess capacity utilization, analyze cost behavior, review related party transactions, verify statutory reconciliation, and identify opportunities for operational improvement. In other words, cost auditors are increasingly expected to function as trusted business advisors while continuing to maintain complete professional independence. Now, CRA 3. Let's understand this. Look at this slide which I put on the screen. Many professionals perceive CRA 3 as a compilation of numerous annexures requiring completion. I encourage you to view it differently. CRA 3 is essentially a narrative of the company's cost accounting framework. Each annexure captures a different aspect of that framework, whether it is corporate information, cost accounting policies, product costs, utility-related party transactions, or statutory reconciliation. Once we understand the purpose behind each annexure, completing the report becomes far more logical and systematic. Now, what is the audit philosophy before filling any annexure? One of the most common mistakes made by professionals is to begin completing the annexures immediately after receiving data from the management. The approach often leads to inconsistencies, repeated queries, and avoidable revisions. Instead, the auditor should first gain a comprehensive understanding of the business, its manufacturing processes, cost accounting system, and internal controls. Only after establishing this foundation should the process of completing the annexures begin. Remember, the annexures are the outcome of the audit. They should never become the starting point of the audit. Let me take you to the documentation checklist before commencing the cost audit. After understanding the business, this is the next step. When I say understanding the business of the manufacturing process, I also advise each one of you to even visit the factory and look at the manufacturing process yourself physically. Now, the checklist on the documentation. Before commencing this particular work, I recommend preparing a comprehensive document request list and obtaining all key records from the management. This serves two purposes. First, it reduces delays during the audit. You are not doing to and fro with the management. Second, it provides the auditor with a holistic understanding of the organization before verification begins. A structured document collection process is often the first indicator of the efficient cost audit. Now, today's roadmap. Before we complete the discussion on the A1, having understood the overall philosophy and approach to cost audit, let us now move to the very first annexure of CRA 3, annexure 1, which is called it annexure A1. Although this annexure appears straightforward, it lays the legal and regulatory foundation for the entire cost audit report. Accuracy at this stage is therefore essential before proceeding to the technical annexures. What is annexure A1? Friends, annexure A1 is often perceived as the simplest part of the cost audit report because it primarily captures the corporate particulars. Look at the slide. As a result, many professionals treat it as a routine data entry exercise and simply carry forward information from the previous sales report. In practice, this is one of the most common causes of avoidable errors. On the screen, you can see the annexure A1 as prescribed under the CRA 3. In practice, this is one of the most common causes of avoidable errors. Just copying it from the previous year, changes in company name, registered office, CIN, financial year, or auditor appointment, or sometimes they're all sometimes overlooked, leading to inconsistencies between the cost audit report and MCA reports. Always remember, annexure A1 establishes the legal identity of the report. Every subsequent annexure derives its legitimacy from the information which is reported here. Now, if you look at the annexure A1, which has been reproduced on the screen, what is the audit objective of annexure A1? One important point I would like to emphasize is the distinction between obtaining information and auditing information. Management may provide a completed annexure A1. This does not relieve the cost auditor of responsibility. Professional standards require us to independently verify the information before relying on it. This distinction is fundamental to audit quality. Now, how will you do that? Source documents required. Now, the slide which I am putting up on the screen about the source document which are required in the audit of A1. This slide introduces a discipline that I strongly recommend adopting in every cost audit. Rather than searching for documents one by one, while filling the annexure, prepare a document checklist in advance. This approach significantly improves audit efficiency and ensures that all necessary evidence is available before verification begins. Notice that completing annexure A1 is the final step, not the first. Every piece of information should be first passed through a process of verification. This systematic approach minimizes the risk of inconsistencies and strengthens the overall quality of the cost audit. Now, just look at the corporate. Let us start with the first one, the CIN number. The CIN number, which is given in the annexures, which I've already shown it earlier. Now I'm putting it in the slide format. What is CIN number? It's a corporate identity number or a foreign company registration number, which is given to a company. Consider a CIN number as the Aadhaar card number of a company. Just as individual as an Aadhaar card, you can show the CIN number which is available in the MCA records. One practical observation from my experience about this is that companies often undergo corporate restructuring, whether through mergers, name changes, or conversions. If we rely solely on the previous year's cost audit report, there is a real risk of carrying forward outdated information. A simple 5-minute verification on the MCA portal can prevent significant reporting issues here. So can you see that even the CIN number requires an audit, an independent verification with the MCA records? The name and registered office. You'll say, okay, what is there to audit about it? This field may appear straightforward, but it often reveals inconsistencies. A company may have changed its registered office during the year, yet internal records or templates may still reflect the previous address. Always rely on statutory records rather than the internal formats. Next comes the financial year end reporting period. The reporting period is not merely a date range. It's just not 1st April to 31st March. It determines the population of transactions subject to audit in that particular date range. Any mismatch between cost records and financial reporting periods must be investigated and appropriately documented. Cross-verification metrics, Annexure A1. If you again go to the industry code, the products, as you can see on the screen, cost auditor, which is again the as you can see in the cross verification matrix. Again, if you see the slide, there are various columns which require to be given. The we come to the cost auditor CRA2, which is all of you are very much accustomed with the CRA2 document, where you will find the SRN acknowledgement that the company has filed the CRA2. Now that we have established the identity of the reporting entity, let us move to the next important aspect of the cost audit report. CRA2, where the details of the cost auditor himself. While Annexure A2 appears administrative, it has significant implications for audit independence, statutory compliance, and the validity of the audit engagement. Faculty recommendation. Now, at this point in the webinar, I would pause for 2-3 minutes and ask you questions. Couple of questions. Let's make it more interactive. How many of you independently download MCA master data before every cost audit? Can you reply on the chat? How many of you do this? How many of you are looking at MCA records before every cost audit? Ladies and gentlemen, it's going to be interactive one. We are all doing this cost audit together. Yes, Shripad, thanks. I'm glad to hear you are doing it. Looking at the MCA portals. Any others? You are doing it at the time of XBR filing and all. Okay. Anybody else? Are you doing it before or after? Have you encountered any mismatch between CRA2 and the final cost audit? Has it ever happened that between the yes, Romain, thank you. And are you finding any mismatch? Yes, master data download before the audit. Very good. This is a standard practice. Have you ever found any mismatch between anybody has come across any mismatch? Or this is more rigorous, Shripad, that you are even doing at the time of even accepting the assignment, which is wonderful. Okay. Has anybody come across any mismatch between the final cost audit report and CRA2? Any answer? And then what working papers or you have come across? People have come across the mismatch between CRA2. This itself shows that we have to always verify the CRA2 data along with the SRA number mismatch is a common, correct, very true. Even a one single digit difference can be changing the name of the company altogether. And so the CRA2 information needs to be independently verified and not taking as it is. Very true. CN number is something which we always find a difference. And then what working papers do we mention? Maintain for Annexure A1. These are the records. The records which you have audited are supposed to be your working papers. Okay. Proper documentation, whatever cross verification you've done within MC records will become your working papers. Again, friends, every cost audit begins with the appointment of the cost auditor. If the appointment itself is defective or not in accordance with the Companies Act and the applicable rules, then the audit report may lose its legal sanctity. Therefore, Annexure A2 should not be viewed merely as a profile of the auditor. It's just not your name, number, etc. It is in fact the statutory evidence that the engagement has been accepted and performed by an eligible professional. Before filing Annexure A2, every cost auditor should satisfy himself that all statutory preconditions for accepting the engagement have been fulfilled. Remember, independence begins before the audit commencement, not after the audit commencement. So, which are the independent statutory preconditions? Section 1. So, what are the enabling act which is governing our cost audit? Starts with the Section 148 of the Companies Act. So the structure is always the act, rules, regulations, and then of course you also have a Cost and Works Accountants Act. So the Companies Act brings into picture section, enables the Section 148 is the enabling section, enabling act which has been passed by the Parliament. Then under this particular Section 148, we have Companies Cost Records and Audit Rules 2014, which has been amended from time to time. So where you will find the cost audit scope, audit applicability, the product, table A, table B, and what are the exemptions, what are the turnover limit, what are the threshold limit. As a matter of fact, cost audit applicability to the product itself is a different subject altogether. And then we are all coming under Cost and Works Accountant Act 1959. We are governed by the ICMAI Code of Ethics. And of course, there are cost auditing standards. There are cost accounting standards and there are cost auditing standards. We all audit under cost accounting standards, which are 25 cost accounting standards. And then we have cost auditing standards, which says what are the ideal way of taking out the cost audit. Key compliance requirement, you should know that you are appointed by the board of directors. You have resolutions. CRA2 has been filed within the prescribed timeline. There's a written consent from the cost auditor given to the company and certificate of eligibility and independence. And in case if you are appointed in place of a previous cost auditor, we have also intimated and under our code of conducts and code of ethics. So this is the basic requirement and CRA2. This completes your CRA2. Now the audit documentation of this. I recommend that every practicing now these are also the documents which we said. But now I recommend that every practicing cost accountant maintain a permanent audit file. It should be separate from the annual working papers. So your permanent audit file, of course, which you all should know, we should have memorandum articles of the company. We should have the SRN, the CIN number of the company, the addresses, and so on and so forth. The entire permanent file, which is not going to change year after year. What changes year after year is the production, manufacturing, etc., which is what covered under the annexures. But the permanent audit file, which becomes part of your annual working papers, is the file which remains, the contents of that file remains good till it is changed. The file should include all documents relating to appointment, constitution of the firm, peer review in case, registrations, and statutory correspondence. Such a practice significantly improve audit efficiency in subsequent years. Many professionals verify only CRA2 filing. However, CRA2 is merely the statutory intimation by the company to the MCA. The primary evidence of appointment remains the board resolution. Both documents should always be examined together. Board resolution content and the CRA2 content should completely match. Let me look at what are the type of auditor details we write. You're writing your name, PAN, email ID, and address of the cost auditor, which provides the authentication of the data the auditor has provided to the institute. It should be exactly same as is appearing in the institute. Your membership number, your email ID, your address. Secondly, whether the cost auditor is a lead auditor or not. Now, some of the companies have joint cost audit, more than one cost auditor. So in case of more than one auditor, we need to check who is the lead auditor and fill the details accordingly in our XBRL. Membership number and name of the auditor who is signing the report. In case of multiple auditors, we need to ensure that the auditor who is signing the report, his membership number and name should always be mentioned. Then comes name of product and service with the CETA heading to ensure every year which products are covered in cost audit and whether their name and CETA number is mentioned correctly. So we'll be writing the name of the product as well. Yeah. SRN number, as I said, we already discussed a lot on SRN. To verify the SRN is correctly mentioned, as we find from various responses I received on the chart, most of the time there is a SRN mismatch happening. This is important. Number of audit committees meeting invited and attended by the auditor. Cost accounting record rules mention about the invitation to the auditor. Cost auditor at least in the audit committee where the cost audit report is mentioned. Uh, now to ensure with the company the number of meetings generally, as all our experience is that most of the time we are invited in the audit committee where the cost audit report is presented. We should mention this, that how many audit committee meetings you are invited and attended. And there are companies which invite the cost auditor in more than one meeting. But at least you should make sure, give them the cost audit report, cost audit report rules, where it mentioned that at least in the audit committee where cost audit report is sought to be approved, cost auditor remains present. Now, our practice is as a practicing cost accountant, we not only remain present, we make a presentation on the summary of the cost audit report to the audit committee. Now, this is about now there may appear to be clerical. This might look like very much clerical matters, but regulators frequently rely on these particulars to establish accountability. Even minor errors can create available correspondence with the company. You see the screen, I put again reproduce the annexure, which is we are filling up regularly year after year. You will see I filled up my own details and given you the example, whether the cost auditor is a lead auditor, category of the cost auditor, whether it is a firm or an individual. So if you are an individual cost auditor, not a part of a firm, you have to write an individual in place of a firm. Then the name of the firm, PAN number, address. This is our address. We have written again. Then the email ID, the membership number, name of member who is signing the report, the name of the products which are covered under CETA chapter, all the products, the group of products which are covered, you have to mention that. SRN number we already discussed, number of audit committee, one, and then date of signing. Now this is important, date of signing cost audit report. It can never be after the date of approval in the board of directors meeting. The last date on which at all you are signing is, so the board of directors approve the report, and most of the time, now the reason I'm saying is because you are supposed to file the XBRL within 30 days after the cost audit report. Now, if you there's nowhere written that cost audit report has to be signed on the date of board meeting. But if you end up signing after 20 days, then when the company will convert into XBRL and when it will be sent to the MCA. So our practice is to be able to sign, but at the same time, it should be signed only after board approves it, not before that. So cost auditor cannot sign the cost audit report before the approval by the board of directors. At the most, he can initial so that the board of directors knows that the audit has happened exactly on the same lines in which the financial audit takes place. Now, why every cost auditor should verify it personally? This is one of the most practical suggestions I can offer. Over the years, I've encountered several instances where the company had inadvertently filed incorrect particulars in CRA2. Had the auditor relied solely on the management assurances, the discrepancy would have surfaced much later. Now, let me talk about so again, I'm on screen, I'm putting the various records which you examine and audit before completing this particular part of the annexure. And common mistakes I'm putting up. There are old address have been copied in the previous, incorrect membership numbers get written, incorrect firm registration get written, wrong signing partner. There are 5 partners. You are writing one partner who audited last year, but the same partner may not be auditing this year. So you should write a correct name of the signing partner. Remember, all your XBRL goes to the MCA, and then there has to be a data match and the synergy between all the data. And again, you are writing old email address. MCA tomorrow wants to write any correspondence to the auditor. That old email address can bounce, and then you are in an embarrassing condition where you not reply to the MCA queries because the emails are not written correctly. Um, the uh, the the independence part is also important, the cornerstone of cost audit. This perhaps the most important message of Annexure A2. The credibility of the cost auditor reports ultimately depends upon the credibility of the cost auditor. Professional competence is important, experience is important, but independence remains indispensable. Um, Now, let me take you to some, uh, you know, uh, some of the situations I have come across. I put it up on the screen. A cost auditor has been appointed by the board. CRA2 has been filed. During audit, it is discovered that the membership number is CRA2 is incorrect. And the question to you, gentlemen, and the ladies, is that should the cost auditor ignore the error because the appointment is otherwise valid? Yes or no? Should it ignore or should he not ignore? His membership number in the CRA2 is incorrect, but board resolution is passed. His name is there. Dushyant Dave is appointed, but his membership number is written correct. Should the cost auditor ignore it error or get the whole CRA2 corrected? Not to ignore, correct. More answers, please. Can I just not ignore because my appointment is there, CRA2 is, and the company might says that so it's already CRA2 is gone to MC, already filed. Why to again correct it? What if you find the resistance from the company secretary? Appointment is not ready. It's also a good answer, Sanjeev. Yes. So at the moment you find this is a very, very important document, very true. This say as a gentleman says, it should be refilled. Yes, CRT has to be corrected, refilled, and refiled with the MC records. The company should immediately initiate corrective action and maintain proper documentation explaining the correction. The auditor should ensure that the particulars reported in Annex A2 reflect the correct statutory information. Now, we also find some other deficiencies during CRA2. You'll be surprised the CRA2 document, which is independently going from company secretary. If you don't verify it independently, the appointment letter, if you need to, so the deficiencies which we cost auditors do most of the time is that nobody verifies the independent things. The company secretary has done his job well. Appointment letter has not been examined. Appointment letter of the cost auditor, I mean, even the board resolution is not obtained. You have been informed, but the board resolution copy is not shared with you. Auditor details are copied from the previous year. What if there is a change in the auditor firm structure itself? What if the individual auditor has become a part of a partnership firm, or it is a part of an LLP? what if the previous auditor himself was a different and the new auditor has been appointed? And then, of course, I mentioned about the incorrect membership number. Then incorrect firm registration number, like, quite a number of people of us, we are all into having one partnership form. The firm registration is given by the institute. We have to not only mention the membership number of the person who's signing the cost report, but also the firm registration number. Products covered in the CRA2 might be differing from a cost report. So you have, again, you have done a copy paste from the previous cost audit report about the products covered. But in the cost records, some of the products have disappeared, new products have come, exemptions have come, 25 crores, 35 crores and all. No documentation supporting eligibility. So your eligibility consent letter becomes a part of it. So prepare a one-page appointment verification checklist for every cost audit assignment and complete it before the field work begins so that you are clear about your own appointment, which is legal. So before moving to Annexure A3, I would pause and ask the audience, how many members personally download and verify CRA2 before starting every audit? Quite a number of people have said, yes, we do download. So you have to download and verify CRA2, okay? Have you ever encountered an error in CRA2 after the audit had already commenced? If you have encountered such error, please bring it to the notice of the company management, get it refilled. Because till the time you find CRA4, you can keep on, of course, changing the CRA2 and correct it. And what documents do you maintain in your permanent audit file? So this is actually very important. Okay, what are the type of document you maintain in your permanent audit file? We have in our practice, whatever permanent, what company can call it permanent, right from the memorandum and articles of association, we make it a part of the permanent audit file. Main messages which we go 6 mainly, which is there on the screen. Annexure A2 establishes the statutory validity of the cost auditor. Key message 2, verify appointment documentation independently. You can take the screenshot of this particular 6 messages, which is takeaway of last nearly half an hour of our talk. Never rely solely on the management prepared information. Cross-check CRA2 with board resolution and engagement documents. Independence should be demonstrated both in fact and appearance. And maintain comprehensive appointment working papers, which is very, very important. Okay, now let's go to Annexure 3, A3. This is going to be a long talk. Be prepared for that and please take active participation in this. Many professionals consider Annexure A3 to be a descriptive annexure. I respectfully disagree. In my opinion, Annexure A3 is the backbone of the cost audit report. We will discuss it very soon. The numbers appearing in cost statements are only the outcome. The policies discussed in Annexure A3 determine how those numbers have been generated. If the accounting policy is inappropriate, then even perfectly prepared cost statements can become misleading cost statements. Therefore, our audit should begin with the policies, not the figures. What is the audit objective of Annexure A3? A good cost accounting policy should produce consistent and comparable results over time. The objective is not to prescribe one universal method. There could be many policies, but to ensure that the selected method is appropriate, logical, and consistently applied. What is a cost accounting policy? Previous. The cost accounting policies are documented. This is what cost auditor should see. Policies comply with the applicable cost accounting standards. So let me here give you a definition part. The cost accounting policy is different from cost accounting system. Cost accounting policy decides how the costs are going to be treated, allocated, apportioned. Cost accounting system could be into SAP, it could be into ERP, it could be into Excel. We are not concerned with it. Each company can have its own methodology of cost accounting system. We are talking about a cost accounting policy. So they should be consistently applied, whatever policies the company has adopted. And of course, our cost accounting standards 1 to 25, it should be complying with that as well. Any changes in the cost accounting policies during the year have been approved and disclosed, but in the cost accounting policy statement in this particular A3 itself, cost allocation principles are reasonable. Reasonable meaning, what I'm saying is if it is an HR cost, you can't allocate on the basis of the gross block of the machinery. Let me tell you, I have found that and I've reviewed it. I got it changed in one of my clients. As far as the ease of allocation, they were allocating HR costs on the basis of machinery or gross block of it. It should be on the number of people because HR is number of people. Cost information reflects the economic reality of operations. The question here is, would another competent cost accountant who applying the same policies arrive at a substantially the same cost? If the answer is no, then the policy deserves examination. Cost accounting policy is a solid foundation and the pillar. A different cost accountant cannot arrive at a different cost. Then there is a problem with the policy, not with the cost accountant. Um, uh, Now the cost accounting standards also are not merely reference documents. They provide the framework for evaluating whether the company's accounting policies are technically sound. As auditors, we should always assess the company's policies against these standards and document any departure or inconsistencies. On the screen, you will find an example of the cost accounting standards. We are not getting into it now. We are going to get into it in more detail when we discuss the pro forma B2 in the subsequent webinars, which are coming up next week or a week after. Now, every company has a unique business model. Okay. And consequently, cost accounting policies may differ from one organization to another. Our role is not to insist that every company follows the same method. You can't say that I'm auditor there. That is the one policy they are maintaining it. You can't have a different policy. There could be 20 different policies. But to evaluate whether the selected policy is appropriate for its operations and applied consistently. That's the key to the entire understanding. The cost accounting policies are the principles adopted by the company for measuring, assigning, and reporting cost. Examples for inventory valuation policies, material issue pricing, FIFO, LIFO, weighted average, employee cost allocation. What do you include in the employee cost? Are you also including the welfare? Are you including the annual other things which you have done for them? Are you including the bonus or not? Are you including the contract workers cost? So on and so forth. Employee cost itself could be a subject. Utility cost absorption. There could be a captive power plant. Depreciation methodology. And on the capacity determination, no, this will go further when we come to the particular capacity slide, but I'm giving an example of the cost accounting policies which you can have to look at it. Now, fundamental audit principles should be fully adhered to. As auditors, we must avoid being influenced by complexity. There could be a very complex organization with 60 plants, it doesn't matter. Sometimes a simple allocation method is entirely appropriate if it faithfully represents resource consumption. Professional judgment is essential here. Your experience of years will become very. So what is important here to look at the policy? Is it logical? Is it consistent? Is it supported by the documentation? Is it compliant with the case? As a matter of fact, the first question answers come when you do with the compliance case. Our case has been formed so very well, so efficiently that every case will put in place all this logical consistency part of the policy. Is it uniformly applied? Are you applying one policy last year and a second policy this year and year after second? No. If you remember, during the COVID period, Institute came out with a specific guidelines for change of the policy or only during that COVID period, because there were a lot of unutilized capacities. The plants remained closed for nearly 18 months. So what do you do with those costs? So that is where the cost accounting policy had to be changed for that particular COVID period. Is it free from management bias? So there cannot be any management bias in cost accounting policy. As a managing director, I should not have any personal say that this should be the policy. The policy should be governed by our cost accounting standards as much as financial accounting standards are covered by the Ind AS or US GAAP. Okay. Uh, Now we can then of course the if you the capable of it should be capable of producing reliable product cost, professional insight. So the objective is not to identify the most sophisticated policy. Objective is to determine whether the adopted policy produces reliable and consistent cost information. Now, I'll of course each element of the cost can have the policies and we can discuss, but definitely we are going to discuss it later on. I will go to the subject of the audit objectives and what are the documents which we are covering in that. Now, this again, we are going to go in detail in B2 for each element. How do we do individual documents kind of a thing. Now, let us go to after annexure A3. I think so we have done A1, A2, A3. Now we are coming to D5. Our first A1, A2, A3 part is over discussion. And now we are getting into D5 and D6 discussions. Now, having established the policies, this was the background. You were appointed cost auditor, you reported, you have done everything. What is to be done for starting your cost audit? You have now getting into the annexure A1, A2, A3 have been completed. We are going to discuss, of course, all B1, B2, etc. But currently, since this requires more time, we have allocated a different kind of a different webinar series for all other format as well, as you can see from the flyer which has been sent by the institute. Now, having established the policies that govern the measurement and assignment of cost, we now move to another area of increasing regulatory importance. D5 is related party transactions. In recent years, the annexure has received greater attention because of transactions between related parties can materially influence product costs, profitability, and the overall fairness of cost information. Our responsibility as cost auditors extends beyond identifying such transactions. We must also evaluate whether they have been they have been valued, and they have been reported in a transparent and appropriate manner. Now, the related party transaction is something which generally cost auditors have been feeling that it is part of the financial auditor domain. Cost auditor probably doesn't have to do anything. But let me give you a completely new perspective on this. Most presentations on Annexure D5 merely explain who is a related party and what columns need to be filled. I don't want to do that. Instead, I would like to teach participants how to audit related party transactions from a cost auditor's perspective. Remember, a financial auditor verifies whether the related party transaction has been disclosed. That's the job of the financial auditor. A cost auditor verifies whether the related party transaction has affected product cost correctly. This distinction should become the theme of this entire section today. Annexure D5 about related party transaction. I'm saying financial auditor has disclosed it, and now I'm saying cost auditor has to see its impact on the product cost. Why has MCA included this annexure in our cost audit report? We will go into that. And because the related party transactions can significantly influence the cost of production, product profitability, transfer pricing, and capacity utilization. This will become the theme of this discussion. Friends, in the last few years, regulators across the world have increased their focus on transactions between related entities. Why? Because such transactions have the potential to distort the costs and profitability if they are not conducted on reasonable commercial terms. For a cost auditor, the concern is not merely whether the transaction occurred. The real question is, has this transaction affected the correctness of the product cost? That is the philosophy with which we should approach the Annexure D5. understanding. Let us understand the related party transactions. Most participants are already familiar with the legal definition. I mean, who is a related party? I put it on the screen. A related party is any individual or entity having the ability to control or significantly influence another entity through ownership, management, common directors, subsidiary relationship, holding company, associate company, joint venture, and also the KMP. KMP meaning key management personnel, relatives of KMP, and also all these definitions are covered under the Ind AS, Income Tax Act, transfer pricing regulations, cost accounting records. So it's easier to know what is the related party. You can easily define by referring to these acts. Okay. Now, why should a cost auditor focus on the related RPT? This is where cost auditor differs on the financial audit. We are not merely recording transactions. We are not merely recording transactions. We are analyzing whether these transactions have influenced product cost in an appropriate manner. One of the biggest audit risks is incomplete identification of related parties. The auditor should therefore first identify the universe of related parties before examining individual transactions. Now, what kind of documents you will obtain? Many cost auditors simply ask management, please provide related party transactions. Instead, henceforth, since currently we are into the peak of the cost audit period, and most of you are still into the process of the audit, ask this. Ask for the register of related parties first. Ask for the register of related parties first. Don't take whatever has been given by the management to you in your D5. Only after identifying all related parties should transaction verification begin. That's the key to the entire thing. The audit procedure should be notice the order. Disclosure is the last step. Audit comes first. This sequence should be followed in every cost audit assignment. What do we frequently encounter the transaction? Not every related party transaction affects product cost in the same manner. The auditor must understand the business context. As I mentioned already, the related party, the definition part of it. How do you understand that the auditor will understand the business context? Let me go to slide 53, 54, and 55 to list overview of this particular point. Give me a second, please. Yeah. We have done very detailed webinar, so we are just doing to and fro from the slides. And so RPT field checklist, you can note down. I'll try to put it on the website if the screen if possible. In the meantime, you have to find out the aggregate value of related party transactions. For that, you will verify the aggregate amount of transaction of each RPT from the signed financial statement of the company. So the financial statement of the company should give you the aggregate value of the entire related party transaction. Basis adopted to determine normal price of related party transaction to verify the method of arm's length price, that is comparable uncontrolled price method, resale price method, transaction at margin method, profit split method, cost plus method, or any other method. So these are the method which is, in RPT transfer pricing mechanism and gets audited by the financial auditor and get reported. You can verify those methods. Verify quantities of purchase and sales, respective quantities to be checked from purchase and sales register maintained by the company of the related party. You don't have to check the entire purchase and sales register. Country of RPT in case of foreign company, CN will not be mentioned. So it will be just a foreign party. So this is part of the, you can look at the the related party transactions and arrive at that how do we impact the impact of this on the cost. Now the question is that are we in a position to look at the impact of the RPT transactions? So each and every annexure, like for example, what will you what are the types of things like compensation paid to key management personnel, dividend amount paid received by the company, purchase of active ingredients, purchase of liquid, purchase of the materials from, and you'll find a very, very long list of this particular RPT transaction. I've been able to put now the whole thing on the screen as well. We have taken out data from one actual company, and you can see there could be purchase of goods of various materials. There could be sale of goods or materials. There could be services as well, like payment of brand equity, royalty. You'll find most of the MNC companies paying royalty to their holding company abroad, and what are the services rendered. Now the question is that whether you are able to impact, can you show that its impact on the cost itself or not? That is the whole point, that are you able to show the cost of this particular impact of that on the cost of a product. Now, all these may not be like, all these may or may not result into the cost impact. But we have to see that whether it affects or not. Now, let me go to the next slide on the after the so, or don't spend all your time on the, so like red flags. What are the red flags in terms of the RPT? Let me put on the screen the type of things which you can now. If the prices of a materials you're finding it are fluctuating very significantly, then you should be concerned, especially the prices of the materials bought or sold from the related party, which affects the product cost. At the same time, it shows an unusual kind of a relationship. A single RPT supplies, majority of the material is supplied by one single related party. Look at that. Royalty is unusually high. As a matter of fact, royalty is a type of a payment which even the government looks very closely whenever the royalty goes out of India to the parent companies. Then management fees are paid as a percentage, but doesn't have any documentation, meaning there is a board resolution which has approved those management fees. You can definitely point out if it is not pointed out and it is affecting the cost. Technical service charges, which increased very sharply in a particular year as compared to the previous year. This is a red flag. Shared costs allocated without basis. In a particular premises, there are more than one company. There could be related party companies in the same premises, same factory premises. Then the costs are shared in a disproportionate ratio. That is a red flag. Large year-end adjustment. This is always a big red flag that transactions have happened only in the last 2 months or last 1 month of the financial year. Frequent debit credit notes happening. Your exchange between the related party and your company, audit company, frequent debit credit notes. There is also a very big thing. So materiality and professional skepticism, as you say, that should guide your audit effort. The moment you look at the DeFi, this is what happens. Our here we must be little. Now let me take you one case study. Okay. For example, a company which purchases 80% of its raw material, ABC to XYZ, and price charge is 15% higher than the independent supplies. What a cost auditor should he ignore because approved by the board, or report only transaction value, or options is evaluate effect on the cost. My question is, a company is purchasing 80% of its raw material from another company. Price charge is 15% higher than the independent suppliers. Should the cost auditor ignore it, or because it is approved by the board, cost auditor says what I have to do, let me ignore it, or should he evaluate the effect on the product cost? And option B is, should he report only transaction value? A, B, C. If you can just write A, B, C, will be fine. Are you ignoring it? You are reporting it, or you are doing an evaluation on the product cost? Yeah. Report only the transaction value. Okay. We would like to evaluate its impact on the product cost, because the reporting, it happens to define any case, but evaluating the effect on the product cost gives a validative report for the purpose of management. It's may not be, perhaps it could be your observation in your audit report, because it cannot form part of the annexures, but definitely it can be this. He should evaluate the cost impact, commercial rational, consistency, the base on which the pricing has been done, and so on and so forth. So there is a whole lot of thing which we now, our role here is not to question. Please remember that nobody should jump to a conclusion that we are questioning why it is done. We are not here to question every commercial decision of management. Our role is to determine whether the transaction has affected the cost information reported in CRA 3 and whether the disclosure is complete and accurate. That's your role. Common mistakes are that which I can put it right on the screen. Related party register is not obtained. Cost auditor never asks for this. Please start asking for it from tomorrow, if not today. Only financial statement disclosure relied upon. Agreements are not verified. Please note, as a cost auditor, you have access to all this agreement. Nobody can say no to you. Transactions below materially ignored without documentation. Shared services are incorrectly allocated. Cost impact is not evaluated. Missing year-end adjustments. No. Now, when you say cost impact, I tell you, we have clients who between the divisions, they make it cost centers, and they sell to the another division at a market price, so that other division doesn't get it at a discounted or a subsidized rate. This is the way in which some of the most transparent companies do it. Missing year-end adjustment I already mentioned, and then there is no reconciliation with the general ledger, which is of course, which is fundamental. So prepare an RPT working paper that maps every RPT to nature of relationship, nature of transaction, ledger, supporting agreement, cost impact, disclosure reference. Please remember, you have a document to audit. It's been put into these particular annexes with a purpose by MCA. It is just not put up without any purpose. The cost auditor role is to see the impact of the related party transaction, the cost of the product, whereas financial auditor reports it. That's the major difference. Okay. Again, D5 key takeaways. I will summarize quickly what we discussed for last 30 minutes again on the D5. Key message 1, begin by identifying the RPT, not transactions. I'm not saying you identify the transactions, you identify related parties. Get a related party register. So you'll get 1, 2, 3, 4, 50 related parties register. You should knowing this. And whether it is reported by the financial auditor. Key message 2, verify completeness before the accuracy. Okay. Third, understand the commercial substance, why it was done, what purpose. If it is a holding company subsidiary, yes. For example, we are auditor of a pharmaceutical company which is present all over the world, and they keep on exchanging the materials from one country to another. You know the commercial substance about this. It makes commercial sense. Instead of buying from outside, they're buying out from their own group companies. Assess the impact on the product cost, very important, because you are here to verify, audit product cost accounting system. You are not here to verify the financial accounting system. So the impact on the product cost is your Bible. It's a fundamental duty. Key messages, another is you can see cross-verify financial statements, ledgers and agreement, and document professional judgment. Whatever you have come to a professional judgment, please document. These 6 messages, please take a screenshot of that on your mobile phone. Write it down and follow this. This should be part of your working paper. Now, we go to the last pro forma of this today's discussion, Annexure D6. Again, friends, many professors ask me why GST reconciliation forms part of the cost audit report. I'm going to give you a lot of emphasis on this particular D6. I'll also share my practical discussions with the large corporate CFOs on this particular D6. And we have, since GST is part of the financial accounting system, how it has appeared by MCA into the cost audit records. Answer is quite simple. GST returns are prepared independently from cost records. Therefore, GST becomes an excellent external source of audit evidence. How do you verify that the GST returns which are filed are correct or not? That can only be from cost records. Why? Because cost records are generated out of the production and sales of the goods. So there is an automatic audit of whatever has been put up into GST as a production and sales is already appearing into the plant records and now culminated into the production records. Whenever there is a significant difference between GST turnover, as you know, our first pro forma only says that difference between the turnover of GST turnover and the financial turnover. The auditor should not merely accept management's explanation. Instead, he should investigate the underlying reason and document his conclusions. Because whatever is sold has to have a GST collected. Simple. Whatever is produced has to be sold or lying in the inventory. So this is how the entire tally how it works. Okay. Now you might find me looking around somewhere because my colleagues are sitting in this conference room and they're also listening to this entire webinar. The audit objective of this Annexure D6 is think of GST as an independent database against which the company's cost records can be tested. If both agree, it enhances confidence in the underlying records. If they do not agree, the difference deserves investigation. That's the word I'm using. It has an investigation. Now, what are the source document we are doing it? One mistake I frequently observe is that auditors begin with the annual figures. Instead, please perform monthly reconciliation first. This allows unusual transactions, missed returns, or late adjustments to be identified much more efficiently. Now, what are the documents? I put it on the screen. The source documents which are required, of course, quite a number of my fellow CMAs are also having a robust GST practice. So they all know this documents, GSTR1, 3B, 9, credit ledgers, liabilities. These are the documents which are the source documents which finally bring the GST D6 gets compiled from these particular records. So this is most of this everybody knows. This is how we do the D6 audit. The D6 audit is done by getting an extract of these records from the company. GST reconciliation framework, notice that Annexure D6 is the final outcome of a sequence of reconciliations. If differences arise at any stage, the auditor should identify the exact point where the mismatch originates rather than adjusting the final figures without investigation. This is important. Also, large companies have plants all over India. They have no number of states. They have multiple GST numbers. They frequently operate through these multiple GST numbers, and a reconciliation performed only at the company level may conceal errors that become obvious when each GST return is analyzed independently. I have put on the screen the state-wise verification process, audit procedure for GST. You obtain all 12-month GST returns, verify table 3.1 turnover with sales register, verify taxable, exempt. The whole lot of process, check zero rated supply exports and exempted supply disclose separately, confirm RCM liability. Some of the vendors don't have to pay. For example, lawyers, they don't pay GST. There's an RCM, reverse charge mechanism, which gets applied here. So you have to look at that as well. And the whole screen, I've given you the way in which it is verified. I'm sure everybody is fully aware about it. But the audit areas which require special attention is your most GST reconciliation differences do not arise from routine domestic sales. They arise from special transactions such as exports, stock transfers, branch transfers, or year-end credit or debit. These areas should therefore receive enhanced audit attention. Like I put it on the screen, what type of things which require detailed verification? So we have even the high C sales, deemed exports, scrap sales. A lot of FMCG companies have a lot of depots and stocks lying into various depots that creates issues. And yeah, and then, of course, one of the important areas is input tax credit and cost records. Now, why it is important? You will say it's part of the GST. No, not every GST amount should be excluded from the cost. Now, suppose the treatment depends on whether tax is recoverable, blocked, reversed, or permanently absorbed by the business. So, in case if you have GST which is not allowed, disallowed, or reverse credit, then they become the part of your cost. It's a complete loss. So, unlike demurrage, you can't exclude from the costing. So, this is how your GST reconciliation and any GST which can turn out to be cost. The normal understanding of a GST is that you are collecting it and giving it to the government, or somebody's collecting from you and giving to the government. But if there is any disallowance, then here is where you can get into the cost impact of the entire GST returns. Now, the next point which I would like to cover is that, again, let me take you a little more deep dive into the financial statements versus GST versus cost. Look at the screen which we have given on the top, on the screen right now, the slide. So your revenue purchases will all remain same. Stock transfers will be different in financial statements, but GST returns cost record should match. Input credit again could be a matter of reconciliation, and reverse charge could be a matter of the matter of difference between the two. This is one. Yeah. And this probably should be complete the discussion on GST as well. Now, what I would like to take you here is that when we talk about cost audit records to audit, or for that matter, any kind of discussion which takes place in the audit documentation which we just now mentioned. Now, are we saying that it is sufficient for us to go as per the just cost accounting standards and accept the management explanation? The discussion which we had today in all this documents which we had is that we have the freedom, we have the authority, as well as there is a kind of a management principle involved into the entire process about where if we can go a little more into the data which we discussed just now. An efficient cost audit is not achieved by completing the annexures quickly. It is achieved by understanding the business, applying professional skepticism, maintaining robust documentation, and exercising sound professional judgment. If our working papers are strong, the annexures will naturally be accurate. In case of a D6, my discussion with a financial group CFO of a very large FMCG company was that he said, we like D6 a lot because here is the case where unorganized sector, which is selling the goods without paying a GST, get caught the moment they cross 25 or 35 crores of turnover or 50 crores of turnover, 100 crores of turnover. Then there is a synergy. I think the organized sector should always welcome GST pro forma D6 because it's getting cost audited separately. Plus, it also completely reconciles the production which happened in the factory along with the GST records and the GST collection which was done. So this is the objective of every statement, which I mentioned about D5 as well, related party transaction. Every format has a meaning attached to it. We can go beyond the dictate of our routine cost audit, which we've been doing it for years, and we can add value by further strengthening our audit process, which we call it an efficient cost audit. I believe this closing message will leave participants with a strong professional takeaway and reinforce the overall theme of the webinar series. It also creates a natural bridge to my session 2, where the discussion moves from foundational annexures to the detailed product and cost information reported in the B series annexures. As you know, the B series talks about the production, capacities, costing, profit, margin, and so on. And this is the most important thing. We are dividing financial P&L account into product P&L account. So this is when we say that. So what are the total 5 key messages I can say about this particular session? Annexure A1 we discussed. It establishes the legal identity before beginning the audit. We discussed at length. Annexure A2, it verifies the validity and independence of the cost auditor. Annexure A3, it audits the accounting policies, just not the numbers. Annexure D5, it evaluates the impact of RPT on the product cost. Of course, cost auditor himself will have to go deep diving into the data. And Annexure D6 is using GST as an independent source of audit evidence. This is our total 5 key takeaways I have summarized in this particular session. And I hope that everybody has taken a note of it. And I also sincerely hope that people will look at the entire cost audit in a little more fresh, those who are not, and each one of us can become very well efficient cost auditor in the times to come. I hand over now the session to WRC to take it further, and then we meet up again in the next Thursday at 3 o'clock to discuss rest of the formats as well. Over to WRC. Over to WRC, Western region. Can we have Prajanka to please take over the session?
Yes, sir.
Yeah.
Any questions? Any questions?
Yes. Anybody, those who get questions a little later on, they can write an email to the WRC. We will reply to each one of your email with full answers for sure. Mr. Marias, thank you for joining. It's a pleasure. It's a pleasure to have you also in the seminar, WRC chairman. Mr. Mirvyas. Thank you.
Sir, on behalf of the WRC, I special thanks to CMA Dushyant Dave, sir. Sir, we have received a lot of messages from the chat box. Event was amazing and very nice presentations. And today almost we have 200 plus members attending the webinar, which was the highest in last few months, sir. So many congratulations, and it is very
Thank
useful.
you.
On behalf of the WRC and PD committee, I thank you so much, sir. And we are looking for more and more sessions like you. We have a special series of you. So I thought our member will get some knowledge from your session, sir. Thank you, sir.
Thank you. Thank you for very nice words. And
Thank you.
I encourage every one of you to please attend every webinar series. This is for the purpose of our own fraternity, for our own profession, as well as for our clients as well. So you please attend all the webinar. Please take a note of it as well. Thank you.
Thank you, sir. Thank you. Means a
Thank
lot.
you, sir. Thank you, sir. On behalf of the Professional Development Committee, we express our heartfelt gratitude to Dushan Dave, sir, and Meervas, sir, for joining the session and wonderful session. And thanks all the participants for the participating. Our next session is on 9th July, Thursday, in on the part 2, Annexure D3 and D4. I request everyone to kindly join. Now we will officially conclude this session, sir. Thank you very
Tomorrow,
much.
tomorrow also, party kindly do join us. We have wonderful session with Narsimhan sir also. So I request everyone kindly join in tomorrow also.
Yes, sir.
Thank you, sir.
Thank
Thank you.
you. Thank you, everybody. Bye.